Are we screwed? I was doing some research and I came across an idea and I just got kind of worried, but also maybe you have a different perspective. Maybe you have a different opinion. So I'd like to know what you think. So just hear me out. So right now, the Dow, right? As of the past 6 months, I'm using the past 6 months just because it makes my point more clear. You could use any other month period; it'll just be less clear, right? Year to date, you don't. For the other indices, you'll see. So, for the past 6 months, you see that the Dow has been up about, we'll say, 10%. Good, right? S&P again up 10%. Great, right? So those are the two U.S. indices. Now let's go to more global indices, right? So here's the Japanese Nikkei. Basically flat. Negative 1%, we'll say flat, even though we'll just say flat, right? Here's France's index. Down 4%. This was a peak. This is a trough. We'll say that's, again, maybe some type of consolidation, maybe some type of flat. Here's the DAX, which is Germany's index. And this is also up 1%, but we'll say, again, that's basically flat, right? So basically from what we can see is out of all the stock indices, the US index is the only one that's really rising. All the other ones, investors have either, like, whatever money is inside that index is staying in there, or they started investing any newer funds into either the US stock index or we'll say gold or Bitcoin, right? So gold, again, up 8%, 9%. We'll say that's about 10% as of the past 6 months. Bitcoin obviously, massive 41% gain. If you're in Bitcoin, if you're in any type of crypto, congrats. That worries me. It feels like a Ponzi scheme, but if you're making money, good for you, right? My only problem is, in my opinion, if US indices are up and gold is up, that means that the US index is more or less a flight to safety for these other global indices, right? So for we'll say the Hang Seng as well, right? So let's do the Hang Seng index. This, again, up 2%. Sure, that's a little bit better than the other ones, but still about flat. So all the major indices, other than the US index, are flat. And then you have the US, basically US economy. When you're investing in the stock market of a particular country, you're investing in their economy. That's up. Gold prices are up. But at the same time, so those are flight to safety, right? So gold is your risk. So in the US domestic investors, right, they see that gold is risk off and the US stock market is risk on. But in my opinion, it seems like globally, their own index is risk on, and then US equities and gold, those are risk off, right? So we can kind of, because this is basically the same. It's basically the same move, right? 10% in S&P, gold price 9%, Dow Jones 8.5%. Basically, it's the same increase, right? So I can kind of see how this is your risk off. So these three are your risk off. These international things are your risk on. But at the same point, like, I don't even understand what crypto is. People say crypto is digital gold, but it really, I mean, is it risk on or risk off? Because in my opinion, crypto is 100% risk on. And the other thing is also, if it weren't for this current Trump pump, you have Bitcoin flat for the past 6 months. You see that, right? Bitcoin is flat for the past 6 months. Other than until people realize that Trump got elected and then bam, rally however much percent, a lot of percent. So if it weren't for this Trump pump, Bitcoin being a risk on asset globally as well would also be flat. So everyone is flying to the US economy for safety. That's from my understanding. Now, my problem is when either US stock market or gold, right? My problem is if you look at where this money is coming from, it's coming from, how do I say this? I guess I'm just saying, where is this money coming from? Right? You see the economies around the world, they're not doing that well, right? You see China's economy not doing well. You see Japan's economy not doing well. Germany's in the shitter. France, Italy, those are all in the shitter. England, everything's in the shitter. And yet we're rising to all-time highs. So what worries me, there's a few things that worry me. One, I know that Bitcoin is highly leveraged. I'm worried that people are using Bitcoin and leveraging their asset in Bitcoin to buy US equities or to buy gold as a hedge, I guess, for their leveraged Bitcoin. Or they're doing it the other way around where, okay, I'm using my assets in the stock market in order to leverage my YOLO into Bitcoin or the YOLO into anything else. And what worries me is this thing called the velocity of money. So the velocity of money is basically how many times money transfers over from until it just leaves the economy. Usually money will leave the economy when it's put into investment, put into a savings account, checking account, never to be used again. So for example, if I earned $1 from selling you a pencil, and then I use that dollar to buy a lollipop, and then the person that sold me the lollipop uses that dollar to buy a stuffed animal, and then that person that sold the stuffed animal puts it into their savings account, then that velocity of money would be 4 people, or four, right? But when you look at Target's earnings compared to Walmart's earnings, you see, when you put those two together, you kind of see the shift in the amount of money that people have. When you have Walmart's earnings, they beat earnings, right? And then Target, they massively were destroyed, right? Like they missed their earnings a lot. You kind of see this shift in how much money that the middle class has. Target is more or less either upper middle or like lower middle to upper middle class, right? Those people are shifting to Walmart, which is, I'm not bashing on Walmart, but they're known for their low prices. So people are kind of shifting over from having excess wealth to cutting costs and buying things at Walmart. And my problem is the stock market, so the Dow, the S&P, the Qs, usually they're funded, or usually they have fundamentals, right? They depend on occasion, or usually, on how much money every company earns. And companies earn money by selling products, by selling services. But when you have more of the money, because the money has to go somewhere, right? It has to go either to poor people, rich people, middle people, right? Poor people already don't have money. Middle people, middle class people, they're losing money, and that money is going to the higher end people, the more wealthy people. The problem is, wealthy people everyone only has their like, you only spend so much money, right? If I gave you $1 billion, yeah, you'd have an initial uptick in spending, but eventually you'd buy like an occasional dinner, after you buy all your gifts, after you buy all your vanity things, you only have basically your basic living costs. And then after that, you just invest everything, right? So when all the money is in people that already have enough money, they're just going to throw it into assets, real estate, stocks, gold, Bitcoin, right? But then that means that money's not being used to stimulate the economy, which means there's a lower M2 money supply. When there's no money shifting hands, buying products, buying services, then that's going to be reflected in earnings. Look at Target's earnings. You can even see Etsy's earnings. Etsy's going down the shitter as well because people don't have as much money anymore, right? They're not going to buy those handcrafted whatever things. They're going to buy the basic essentials. So I'm just worried that, so basically what I'm saying is, when the middle class and the lower class stop spending as much money and inflating those earnings for the companies, that the companies need their business in order to grow, right? The S&P, the Dow, they need that money to grow. But when you have less spenders, that's less profits, that's less earnings, and that's going to show in their fundamentals. And then when people realize this, they're going to see a weakness in the economy. This is, I feel like this is going to be even more explosive because you have all these other countries, all these other investors from other countries also flocking to US as their safety, as their safety nest egg. And if that stock market crumbles, then you have not only like a great financial crisis, you have like global financial crisis. There's no, like, your only flight to safety, what is it, gold? And the problem with that is, if you're buying gold, if you're buying Bitcoin based off of leveraging the money you have in the stock market, I don't know what's going to happen, right? And at the same point, you have no one investing in treasury bonds. And no one's going to invest in treasury bonds because when you increase tariffs, when you're trying to decrease taxes, right? Most of the time, Republicans like tax cuts. When you decrease the amount of money flowing into the government, they're going to need to sell bonds, and then that will create even higher supply of bonds so basically people that are projecting a higher supply of bonds would want to wait until the price of bonds goes lower, which means a higher yield, until they buy. So no one wants to buy bonds right now. And then if no one's spending money, the stock market is inflated on what I project to be worse earnings. And then if that crumbles, you have this chain reaction that, in my opinion, might be worse than the yen carry trade by a lot. But these are just my ideas. These are just my opinions, or not even my opinions, just my thoughts. So this could be, I could be completely wrong. I don't know, right? But I'm just worried that everyone globally is flocking to the US market as a safe haven to store their wealth. But what if that's not the right safe haven, right? What if anything goes wrong, we're basically doomed. If you, there's a book, or there's an author that I really like called Nicholas Nassim Taleb. I talked about him in a previous video, but you don't want centralized points of failure. You don't want a thing that's too big to fail, because if that thing does actually fail, we're all screwed. You want decentralized points of failure, or if that makes sense. So you want, like, an example he gives is, instead of having one massive nuclear reactor, you have 10, 100, 1,000 mini nuclear reactors, and then if any of them blow up, then it's much easier to solve than if that one giant thing explodes. Same thing with banks, right? You don't want one massive bank that's too big to fail, because when that thing that actually fails, great financial crisis. Versus if you have 100 mini banks, if any of them individually fail, it's much easier to clean up the mess and to absorb that impact. An example, or a more everyday analogy he gives is, if you were to jump up 1 foot, and then that means you fall down 1 foot. Would you break your leg? If you were to jump up 100 times 1 foot, would you break your leg? You wouldn't. But if you were to drop down 100 feet, you would probably die, right? If not, you'd be severely injured. So you want to increase the number of times you fail. At the same rate, you're decreasing the amount of impact that it has, as opposed to it getting a massive impact all at once. And I'm worried that if everything is centered on basically the American economy, and then something happens, we're screwed. But this is just Bear Jason coming out of nowhere. So I mean, if you have any other perspective, I'd love to know. I'd love to hear it, and I'd love to hear your perspective and just try to learn and just hopefully we all make money together. But yeah, those are just my thoughts. Kind of bearish, kind of sad, but it just kind of worries somehow. All the money, like what Americans see as a risk on asset, the stock market, maybe even crypto, right? Other countries, other investors are seeing as a risk off asset. And no one's buying bonds right now, which is even more scary because that just means that people don't have faith in the American dollar or the American economy, but then they're also, or the American government, but they have faith in the American economy. And I don't know what. Have a good day.